Martin, what is your central projection for where crude goes from here? And what kind of volatility are you expecting as we work our way forward from here? Because at the moment, we're really struggling to price a barrel of crude.
Yeah, no, it's not easy. To say that the oil prices have been volatile recently is kind of an understatement. Our call is for oil prices to rise. We think the summer will be tight. We're forecasting $120 a barrel by the third quarter. After that, our current price assumptions assume that some counterbalancing factors will kick in, that it will drive us back down to something that looks like $100 a barrel Brent for the then remaining part of the year after the summer and into 2023. But having said that, though, these counterbalancing forces still need to emerge, and the margin of safety in the oil market is very tight, and that adds to price levels, but it also significantly adds to volatility.
Martin, let's talk a little bit about demand here. One of the big calls simply has been that demand destruction is inevitable. Some oil CEOs in the States already saying that there's signs of that afoot. I'm curious about your take on demand destruction. Are we headed for somewhere similar to the 80s where you could see it kind of plunge into recession? Or can you have demand destruction without killing an economy altogether?
Yeah, so history doesn't give a kind answer to that latter question, to be honest. If we're struggling to supply, and I would argue that we clearly are, in the end, the oil market needs to balance. It's a finite number of molecules. We can draw them from storage during periods where we're undersupplied, but you can't draw from storage forever. So, with a finite number of molecules, we can't simply print them. Eventually, one way or the other, supply and demand need to come into equilibrium. And as you rightly point out, the most topical question at the moment that we discuss with our investing clients is what is the price that will erode some of the healthy recovery in demand that we've been seeing. That price is likely to be very high. It's been somewhat of a moving target. There's not an easy framework that will give you a precise answer, but that's what we're searching for. Even if you can answer that question, then it still remains, you still have the issue, can price simply destroy the demand in isolation, or does it need to come via a broader economic slowdown? And history suggests that the answer to that question is probably yes, as in it probably requires a broader economic slowdown to then destroy enough oil demand.
Martin, I'm wondering, you talk about that price being relatively high. Consumers are facing not only high energy costs right now, they're facing high costs for pretty much everything. Does the fact that pretty much everything is high right now lower the point at which we see demand destruction in the energy complex? Because consumers are really struggling on a number of fronts right now. So I'm wondering whether that point is lower as we see the breadth of this commodity rally.
Yeah, look, this is a very sort of hotly debated topic, and it's one of the reasons why we still have forecasts that are perhaps a little bit on the low side for price relative to what you could argue or could justify simply based on the answer, what is the demand destruction price? If you start to look at the oil market historically, we often look at the oil burden on GDP as the percentage of global GDP that we spend on oil consumption. It was relatively high in 2011, 2012, when it nearly got to 5% of global GDP. If you take 5% of global GDP today with our current oil consumption, you get to something like $120, $125 a barrel. The issue with that analysis is that, yes, in 2011, 2012, we spent relatively, quite a large percentage of global GDP on oil, but actually in those years, oil demand continued to grow at quite a decent rate, well over 1 million barrels a day, which is sort of broadly trend growth. If you want to go back further in history and say, well, can we find a period where actually price led to a decline in oil demand, you need to go back to 1980, when we spent a little over 6% of global GDP on oil. On that basis, you could potentially justify a little more than $150 a barrel. That's what that analysis would point you towards. But at the same time, both in 11, 12, as well as in 1980, we didn't have high gas prices at the same time. We didn't have high coal prices at the same time. We didn't have high copper, aluminum, and other commodity prices at the same time. So perhaps some of these historical analysis, you also need to discount them a bit to take into account precisely the effect that you're mentioning. Having said that, though, pricing oil out of people's lifestyles and our daily lives, how we go about things. Oil forms a rather critical part of that. So getting rid of a lot of oil demand quickly is still not so easy.
Martin, talk to us a little bit about the supply picture here, the ramp up in particular, not just from OPEC, but from shale. Of course, we know there's a narrative about capital discipline. We know that the White House has been trying to get more supply from the U.S. sector. It kind of seems like it's more of a question of simply turning on the taps. There are supply chain issues that are impacting this industry. Can we actually bank upon perhaps a shale boom 2.0?
Yeah. Well, perhaps as a starting point to a comment on this, I think it's worth pointing out the divergence that currently exists between the trends that we see in inventories and what a lot of supply-demand data suggests. If you look at a lot of the supply-demand balances of the IEA or the U.S. Department of Energy or the OPEC Secretariat, actually the oil market should be either balanced, if not somewhat oversupplied at the moment. That's what most of those sort of key forecasters point at. The thing is, if you add up all of the inventory data that we can get our hands on, we see sharp continuing draws, very severe draws, well over 1 million barrels a day. The inventory data tells us that we're more than 1 million barrels a day undersupplied, which is surprising given what we've had from a lot of supply demand numbers. Now, so we have a large gap to bridge. I would contend that given diminishing levels of OPEC spare capacity, supply chain issues in U.S. shale, we can do a bit, but not close that gap entirely.
Martin, just very quickly, what would Iran add in? What would Venezuela add in?
Yeah, Iran can add in a lot. We assume that between the midpoint of the year and the end point of the year, Iran will ramp up both exports and production by about 1 million barrels a day. I would characterize that as a broad, full sort of recovery of Iran. We have that in our models. I can see a lot of other supply-demand balances. It seems that the oil market is broadly expecting this. If those barrels come, that would be no surprise to anybody in the oil market. Those barrels are largely accounted for. Venezuela, much more difficult. Could be a few 100,000 barrels a day, maybe, but the Venezuelan oil industry has suffered from quite systemic long-term underinvestment, and that oil is fundamentally more difficult to produce than the Middle Eastern oil. So that will take more time, more investment. The return of oilfield service companies to the country, that's an altogether more difficult story.